Imagine the most expensive yacht in the harbour, a symbol of wealth that everyone thought was unsinkable. For decades, it cruised through every storm, but today, the hull is breached, and this icon of prestige is taking on water faster than the pumps can handle. While the media focuses on daily stock market noise, a massive structural shift has just occurred. The titans of luxury, Saks Fifth Avenue and Neiman Marcus, have officially filed for bankruptcy. It's a signal that the very top of the American economic pyramid is running out of air. But behind the headlines, one single, shocking figure defines this week: 2.7%. This latest inflation data reveals that while luxury is dying, the cost of your everyday life, rent, eggs, and electricity, is still stubbornly rising, creating a pincer movement crushing your ability to save. This luxury leak is the first domino in a larger chain reaction. If you don't pivot, this shift will eat your savings. However, there is a secret exit. Stick around, because in our scenario planning, I'll reveal the specific asset class big institutional players are moving into right now. Before we dive into the why, let's secure your perimeter. Your first line of defense isn't hunting for a moonshot stock, it's building a firewall. You must immediately check your exposure to consumer discretionary stocks, companies that sell things people want but don't strictly need. Why does this matter? Because when luxury giants fail, it means the aspirational buyer is broke. If you own companies relying on middle-class consumers spending money they don't have, you are standing on a financial trapdoor. Audit your portfolio today and look for high-debt retailers losing customers. Next, you must freeze the parasites. In an environment where the Fed keeps rates high, variable rate debt is a death sentence for your wealth. If you have credit card balances, pay them off or move them to a fixed rate loan immediately before the credit markets tighten further. Protecting your wealth requires staying 2 steps ahead of these cracks. That is exactly why we created Sketching Finance, to turn complex market shifts into clear stories. If you want to keep your family's future safe, hit that subscribe button now and join our community of smart investors. The simplest way to look at your personal finances is an efficiency audit. Think of it like a corporate restructuring. Meta just laid off 1,500 people to cut the fat. You should do the same. Cut every recurring subscription you haven't used in 30 days for an immediate pay raise. Now that you've applied the first aid, we need to open the hood of the global economy. To understand where the money is going next, we have to grasp the hidden mechanism that just broke the engine of the luxury world. Let's look at the aspirational squeeze. Let's use some kitchen table economics. Imagine your monthly income is a loaf of bread. A few years ago, that bread was cheap. You had plenty of money left over for that fancy, expensive organic jam on the side to make life sweet. But today, the price of the bread itself has tripled. Even if you're making more money, the cost of the must-haves has swallowed the budget for the nice-to-haves. You got the jam off the table because you need the bread to survive. This is the squeeze killing high-end retail. There's a hidden force here called gravity. In the financial world, interest rates are the gravity. For 10 years, gravity was zero. Companies could carry massive debt and float easily because borrowing was practically free. But now, the Fed has turned the gravity back on, and it is heavy. Saks and Neiman Marcus were carrying billions in debt. When they had to refinance at 8% instead of 3%, the gravity became too strong. They didn't have enough cash flow oxygen to stay upright. In 2026, only companies that don't need to borrow will stay alive. We've seen this movie before. Back in 2008, luxury retail was the first sector to show deep cracks. When the people who think they are rich stop spending, it is a leading indicator that the people who actually are rich are starting to get worried. Economists call this the canary in the coal mine. When luxury stores close, it tells us the economic air is getting thin. It happened in 2000, 2008, and it is happening now. This signal tells us the wealth effect is reversing, and the wider economy feels the chill soon after. Look at how the smart survivors are reacting. Meta Platforms just laid off 1,500 people from Reality Labs. They aren't waiting for a miracle, they are performing surgery. They are cutting moonshot projects to protect core profit. moving from growth at all costs to extreme efficiency. The market is no longer rewarding companies for dreaming big. It is rewarding them for being lean and profitable. Knowing this shift is vital, but it is useless without a specific plan for which path the market takes next. We stand at a critical fork in the road. While retail investors panic over bankruptcy headlines, the smart money is quietly finding the bottom. They are exiting shopping malls and moving capital into the plumbing of the digital economy, like high-tech warehouses and AI data centers that society actually needs. Look at Blackstone. Their giant real estate fund just finished paying redemptions and is growing again. They found yield in the recovery by betting on essentials, not vanity. Now, let's look at the two paths for your money as we head into the next quarter. Scenario A is the pivot. This happens if inflation finally hits the Fed's target and they start lowering interest rates. This would be like turning the water tap back on, allowing the economic engine to cool down and debt to become affordable for businesses and families again. In this case, look for quality value. These are strong, cash-rich companies unfairly sold off during the luxury panic. When the gravity of interest rates gets lighter, these companies will fly first. If scenario A plays out, you want to be positioned as a high-margin tech leader. But what if the path turns right? Scenario B is the squeeze. This happens if the 2.7% inflation stays sticky and the Fed keeps rates high while the job market weakens. This is the stagflation trap, where prices rise but the economy and your opportunities shrink. If this breaks, pivot 100% into essential moats. These are companies selling products people must buy. Think healthcare, basic utilities, and discount giants like Walmart. In scenario B, the luxury yacht sinks, but the essential lifeboats stay perfectly dry and even grow. So, where is the smart money hiding? They are moving into defensive cash flow. They aren't betting on the hope of future growth anymore. They are betting on companies that already have mountains of cold, hard cash in the bank today. They are buying safety and getting paid a 4% yield to do it. This is how the pros survive a retail wipeout, by owning the things society can't afford to stop using. They effectively become the landlords of the economy, while everyone else is just a tenant. But be warned, don't fall for the retail trap. As stores struggle, many will offer massive dividends to stop investors from selling. But if a company doesn't have the cash flow to cover its debt, that dividend is a mirage that will disappear overnight. Always check the interest coverage ratio. If a company isn't earning enough to pay its interest twice over, it is a ticking time bomb. Now that you have the map and the warning signs, let's lock in your final survival checklist for the weeks ahead. Here is your survival checklist. First, kill your variable rate debt before high interest rates crush your savings. Second, shift your investment focus from growth dreams to cash flow reality. Look for companies that are cutting fat and staying lean in this new environment. Third, pick your defensive moat. Whether it's healthcare or discount retail, ensure your assets have the structural strength to stand against a weakening consumer. Protecting your wealth isn't about being right all the time. It's about being prepared for when the market is wrong. Managing your portfolio through a retail collapse is vital, but it is ultimately useless without understanding the one giant force that holds every asset together: the power of the US dollar itself. If the dollar cracks, the rules change again. If you want to keep sketching your path to financial freedom, subscribe to Sketching Finance right now. We do the deep diving and the visual storytelling so you can make expert decisions without the jargon. Your future self will thank you. There is a silent war happening inside the Federal Reserve that could change the value of every dollar in your bank account forever. It is a battle for the Fed's independence, and the stakes couldn't be higher for every American investor. In our next video, we explore the Fed independence crisis and why your savings might be in the direct crosshairs of the next political cycle. Click here to watch that story now, and I'll see you in the next sketch.